those are the headlines that we are going to be tracking for you all evening on ET Now. Well, our first topic of discussion is taxation, and more specifically taxation on capital gains. Well, you are considered as enjoying capital gains when you purchase something at a low price and eventually manage to sell it at a higher price. This is usually an asset. This asset could be land, building, or shares. So talking about shares, in this last 1 year especially, investors have enjoyed massive capital gains. If you had the foresight and hindsight of investing back in March, April, or May of last year, you've enjoyed tremendous gains. The Nifty 50 has returned 50%. The mid and the small caps have done even better. Those indices have returned 80 to 100%. So with all of these gains being enjoyed, it could be tempting for a lot of you to book your profits. But now with taxation coming into the picture, it could make you all wonder that, at least make you perhaps a little skittish on the tax bill that will come up as you try to book all of these profits. Because today, equity shares are taxable at the applicable are taxable at 15% in case of short-term capital gains, and if you have enjoyed gains of more than 1 lakh rupees, then it's taxable at 10%. Even debt funds, if it's short term, it's taxed at your tax slab rate, and if it's long term, then it's taxed at 20%. So all of this can make you rethink on booking your profits, or at least make you think that how can you manage this tax bill. Well, to discuss this, I have with me Amit Maheshwari, tax partner at AKM Global. Amit, thank you so much for taking out time and joining us today on the Money Show.
My pleasure. Thanks a lot for inviting.
Let's talk then about this market rally that we have seen. It's resulted in some big gains as well for some shareholders, many who would like to book out, who are just about to book out as well. What would you recommend they do for efficient tax management, or to try and reduce their tax bill to the bare minimum?
Sure. So first of all, booking of your gains is a personal decision based on your personal financial goals and the view on the market. The markets have run up quite a bit, but still India presents a solid growth story. In terms of booking the profits, I think one important thing to remember is that the short-term capital gains are taxed at a more higher rate than long-term capital gains rate. So ideally, an investor should try to make the profits long-term in nature by trying to at least hold them for a year, if that is possible. The other thing which they can do is that instead of they can stagger it between different financial years rather than doing it at one go. So there is a possibility of taking that 1 lakh limit exemption every year. So if that is possible, again, that's a recommended strategy. Also, if you have certain shares which are at a loss, so one strategy could be you can book those losses in the financial year and then repurchase it in the next year. So that is something which can be easily be done. But again, it entails some cost in terms of transaction cost, but at least those losses are available for an immediate set-off. And you can also purchase a house property under Section 54F to claim an exemption. So if you purchase a property within 1 year before or 2 years after the date of transfer, or you construct a residential house property within 3 years of the date of transfer, you can claim your capital gains as exempt under Section 54F. So I think these are the broad strategy, and it depends on your own financial goals, what is your view on the markets as well as the real estate market.
Okay, just to reiterate, Section 54F, though, is applicable for capital gains enjoyed on property. So if, let's say, I've sold a house in this fiscal year, but then I purchase another residential house in the time period that you mentioned, Amit, just to clarify, only then will I get that exemption, right? It's not that I can, deploy my funds that I've enjoyed through my sale proceeds of shares into property and still enjoy exemption. Is that right?
Yeah, so there are two sections. Section 54 is when you sell a property and you buy a property. 54F is when you basically sell something other than property and buy a property. So there are two different sections. I was talking about the second one, 54F. And there you have to invest the entire sales consideration to claim that exemption.
Oh, okay. So basically, if I have enjoyed, capital gains on sale of shares, but I use those entire proceeds to buy a house, that capital gain will be exempt. Am I right?
Right.
Okay, great. All right. So, essentially, many methods actually explained by Amit, consider firstly making it, instead of short term, long term. So try holding it for more than 1 year. That's equity shares. Secondly, consider staggering it over different financial years. As you know, you get that exemption of 1 lakh rupees per financial year. So try staggering it so that your capital gains are under 1 lakh. And of course, if certain investments are at loss, book some of those losses accordingly. So let's talk about that, what we call as capital losses. Amit, now there are so many kinds of losses we could be facing. There could be losses in my debt funds. Unfortunately, we have been seeing that right now. Some could be called short-term capital losses. Some could be called long-term capital losses, again depending on the period for which I have held the shares. So how exactly can one manage that? What kind of loss can be set off against what kind of gains?
So in terms of in capital losses, if you have a long-term capital loss, that can only be set off against long-term capital gains. But if you have a short-term capital loss, that you can set off against a short-term capital gain or a long-term capital gain. So therefore, short-term capital loss has a wider usage in terms of usability, in terms of reducing your tax bill.
Okay. So maybe, just pull up your profit and loss account of, your investment accounts or your trading accounts and take a look at where is it that you are seeing losses. If you don't believe that this particular investment is really going to recoup or rebound, and if it's particularly a short-term one, and at the same time, you are enjoying capital gains on a variety of other investments, then it makes sense that you book. And if you want to book profits, of course, then it makes sense that you book your profits over there and book your short-term losses here, because you get that advantage, because you can minus the loss amount from your profit amount, and then still you have a variety of things to do with that. For example, invest the sales proceeds in a property. So that can be done. By the way, Amit, a follow-up question: the 1 lakh rupee exemption which is there on long-term capital gains, is this after deducting for any long-term capital losses or short-term capital losses, or is it as a gross figure?
No, it's after deducting. And it is after deduction. And just one point which I wanted to add. So you can also take the benefit of your historical losses. So if you had capital losses which are there on your prior year returns, and those are being carried forward, you can take advantage of that as well and claim that as a set-off in this year. So it's very important to look at your prior year tax returns and see if you have any losses which are already there, and can you use that to set off.
That was actually going to be my next question, Amit. How long can I carry forward these losses? Because it could happen that my loss figure is very huge. So for how long can I carry it forward for potential future gains?
So you can carry forward it for 8 years. So in the year in which you calculated, so 8 years after that you can carry forward. So you can set it off in any of those years.
Okay, Amit, we've largely spoken on equities. Let's talk about the debt funds bit. Last year, long duration funds gave double-digit returns, but so far this year, it's been in the red. We've been seeing losses in debt funds. How can investors manage these from a tax point of view? Can the losses that we see in our debt fund returns, or in in the debt side of the portfolio, be used to set off the gains that we've been seeing in equities?
Absolutely. So there's no restriction of on using the losses of debt funds to set off your gains from equities. They can be freely used, provided, again, like I said, if it is short term, can be used for short term. Long term, if it is long term, can only be used for long term. So I think, again, if your debt funds are seeing losses, considering the inflation would remain low, and a lot of people, financial planners, are foreseeing debt funds to give muted returns in the future also. So it may make sense to book those losses and get out of those funds, and those losses can be used for tax planning purposes as well.
So for all those debt fund holders who invested in the beginning of the year, all is not lost. Chin up, because yes, you may be looking at some red on the screen over there. You may be looking at losses in some of those long and medium duration funds, but if you are seeing green in your equity funds, you can set off those losses with your equities. It doesn't matter what kind of investment you're looking at, as long as, of course, it's a short-term capital loss. In debt funds, which in this case it will be if you invested in the beginning of the year, use it to set off either long-term capital gains in equities or short-term capital gains in equities. I guess that's the only silver lining we can find of these gashes that we are seeing on the debt fund side of the market. What about the frequent income that we get, Amit, from these equity and fixed income investments? A lot of them give dividend, they give interest, whatever the name be. How are these taxed today?
Yeah, so earlier dividends were actually not taxed in the hands of the individual investors, and they were taxed in the hands of the company declaring dividends. So that's now changed, and dividends are taxed in the hands of the individual. So they would be added to your regular, they would be considered as regular income under income from other sources, and would be added to your total income. And you get taxed as per your gross, as per your slab rate. So no concessional rates there. Interest, again, same treatment. Interest is a tax deductible expenditure in the hands of the company, which is which is paying interest. So dividends are now totally taxable. So again, whether you get it from equity funds, debt funds, whatever the case may be, if it is a dividend, it is going to get taxed and added to your income.
Okay. All right, there you have it. That's everything to do with the gains or the losses that you're enjoying on equities as well as debt, and of course how are the frequent incomes that you received as well taxed by the tax man. I have one more question, Amit, and that's to do with the income tax website. I don't know if you've been able to go through with it, because everybody who we've spoken to seems to have encountered some glitch or the other, so much so that the finance minister as well then intervened and ensured that those glitches are fixed sooner rather than later. But yeah, Amit, just a quick question on that. What were the stark features of the income tax department website? Because the one thing they promise is that it's going to be more user friendly.
So clearly, obviously it's a credible attempt, but the problem is that the reality on ground is very different, and we are facing a lot of issues. So for example, we had clients which wanted to do foreign remittances, and those kind of forms were not there. We were not able to access them. So we had to actually go to the manual method of doing it. A lot of issues are there in terms of issuing refund requests. So we are not able to do that. OTPs are not getting generated. Login ID passwords are again having a lot of issues. So, it is a very difficult experience which is going on. If you look at the social media, and which was flagged to the finance minister where she overhauled up Infosys, I think there are a lot of genuine issues which are happening, and taxpayers across the board are facing trouble. And this is something which, it's a credible attempt to ease compliances. And once the website is fully functional properly, then I'm sure it would be a much better experience. But as of now, it is a very painful experience, and a lot of things are being delayed because of such glitches. So hopefully, I think with the intervention of the finance ministry and Infosys being such a good brand, I'm sure they will come together and fix this. But as of now, it's quite a lot of issues. Mismatch of PAN data. Some very basic stuff that's not happening properly.
Well, the intent is a great one, a good one, but unfortunately the implementation is facing a great deal of hurdles. In fact, the Finance Minister Nirmala Sitharaman held a meeting as well with Infosys, with the stakeholders like the ICAI, which is essentially the Chartered Accountants apex body on the glitches in the income tax guidelines. And ET now learns that the ICAI in fact made presentations on various issues being faced by the new income tax e-filing portal during a meeting with the finance ministry officials and of course the Infosys representatives as well, who've essentially created the whole website. The ministry organized a meeting to review the glitches and also issues related to the new portal, which by the way was launched just 2 weeks ago on the 7th of June. The FM also asked Infosys to address all issues without any further loss of time, improve services, redress grievances on priority, as it was impacting taxpayers quite adversely. And of course, remember, the entire bit around taxes is that it's all about deadlines, right? You have to complete certain tasks before deadline or face a penalty. So all the more this takes on a lot of importance. Okay, very quickly, let's take on board some questions and queries then from our viewers. Remember, you can connect with us on the Money Show at etnow.tv. Our first question is from Bharat Vivedi. He asks, what's a good tax saver option between PPF and ELSS in the long term? PPF gives fixed return, but at least I'm seeing some consistency in returns compared to ELSS. Well, Bharat is essentially combining a personal finance and an investment question with a tax one. I suppose that is a good thing to do, but yeah, if we have to compare the two, where would you put a big chunk of that 1.5 lakh rupee exemption that's available, Amit?
So, I mean, as you rightly said, it's a personal choice. One is debt, one is equity, both on two very different opposite sides of the spectrum. But a few things to keep in mind. PPF has a lock-in period of 15 years. ELSS has a lock-in of only 3 years. Interest from PPF is not taxable. Gains on ELSS would be taxable as equity shares. So one has to keep in mind one's financial goals, need for liquidity. So PPF is actually a very illiquid instrument. The other thing is that on redemption, again, as like I said, PPF, there's no tax. So it's important to see where your financial goals are, whether you need money immediately. I would recommend, considering the equity markets have run up that bit and a lot of funds are not able to even beat their benchmark. It makes sense to have PPF also if you don't have an exposure. But don't overdo it, because PPF rates, as we know, they are being consistently being brought down. And in fact, last time also it was brought down, and then because of a lot of hue and cry, it was reversed. So long-term trend of PPF rates would only go down. So again, but it's a personal finance question. I think from a tax perspective, it's very clear, and PPF is a better option for taxes.
Okay, very quickly, let's take on board a next question. In fact, we've just received this one on our email address, themoneyshow@etnow.tv. It's coming in from Mr. M.D. Matthew. Now, Mr. Matthew says that recently the second call money was paid on the Reliance partly paid shares. As we know, that call was just made, the partly paid shares were listed as well. However, here's where it gets interesting, Amit. He says in his Demat account, the partly paid shares were first debited and later the shares were credited with the 5 rupees that he has paid. So because it got debited first, in that process, capital gains got generated, even though, of course, technically, Mr. Matthew did not sell his shares. So, Amit, how does it work when it comes to partly paid shares? When you are asked to pay the second call money, does this usually happen where, the part paid shares are debited and then, the full paid shares are credited? Or do you think in Mr. Matthew's case, he must ask the depository participant about this thing that has happened?
Yeah, so I think in the partly paid shares are actually a different asset than a fully paid share. So when it is debited, it would be a different taxable transaction, and when it is credited, that would be a purchase transaction. So unfortunately, in this case, there would be gains, but I think Matthew would have to see what was his purchase cost and the sale price to calculate that.
Okay, so essentially he would have to pay capital gain tax on this, Amit? In your opinion?
Yeah, according to me, yes. I'm not sure how was that did that happen in this Demat, but seems to be the case. Yes.
Okay. All right. Well, let's take on board our next question from Pooja. She says, I am a salaried employee with a private company. I draw a salary of 10.5 lakh rupees per annum. Now, she says, in the beginning of 2019, I invested a part amount of 13.5 lakh rupees in my husband's commercial property, which was worth 1.5 crores. So I think she's just made a small investment contributing to that 1.5 crores. She says she filed the TDS etc. too on behalf of the developer, and her husband made her a 30% partner in the business in lieu of this investment too. It's making profit, but we have not drawn any of the profit. Do I have to disclose all of this anywhere in my return? She also says that I have the usual investments like equity shares, mutual funds and PPFs. Okay, this is an interesting one. When you purchase property or when you make a part investment in property, plus you are made a partner as well in a business, even though you're a sleeping partner, which I'm sure Pooja is, considering that she's a salaried employee. Amit, are there any disclosures to be made to the tax man via the return?
Yeah, so if you have more than 50 lakhs of income, you are required to disclose your assets. And these assets would be like equity shares, mutual funds, PPF, stake in a partnership firm. They will have to be disclosed in the tax returns, and you will have to disclose the name, PAN, and the percentage of the profit share of the partnership firm in the tax return also. So it has to be reported. If you withdraw profits from a partnership firm, that withdrawal of profit is actually tax exempt. But all these investments will have to be reported in the tax return.
But in case if the income is above 50 lakh rupees, so in the case of Pooja, she does not really need to, that means report any of that, because her income, as she says, is 10.5 lakhs. Is that right?
Yeah, I mean, she's saying that her salary is 10.5. I'm not sure about the other incomes which she has, but yes, assuming if this is the income, then not, then it's not required to be reported.
Okay. All right. So only if your income is above 50 lakh rupees, Pooja, calculate what your total income is from salary, from interest here and there. And if it's above 50 lakhs, you will have to make disclosures in your return. Okay. I think we have just got a few more questions from Tushar Vai. He has two questions, in fact. So let's take both of them. One, he had asked us about how our InvIT returns taxed. In fact, I think one of our other viewers, Mohit Gupta, as well, had asked that, how is the dividend from InvITs and REITs taxed, or is it exempt? So I'm just going to club the two questions. And the other question that Tushar has asked, apart from InvITs and REITs, is that I'm going to incur more than 1 lakh rupees of short-term capital gains. That means he's held stocks under 1 year. Does it matter how much my income slab is while deciding the tax on these earnings? So essentially he wants to know, how is short-term capital gain on equity shares taxed? Amit?
Can we take the, InvIT question first?
Sure, go ahead, Amit.
Yeah, so InvIT, the streams of income of, so InvIT, if you sell InvITs, it would be taxed at 10% if it is a long term, and if you receive interest income or dividend incomes, those are all taxed in the hands of the shareholder. So in dividends, what happens is that if the SPV from where the dividend is coming, if it is it has paid tax at a concessional rate, the corporate tax rate, then the dividends are taxed in the hands of the unit holder, otherwise not. So that is on dividend. Interest income is definitely taxable. What was the second question on the, I'm sorry, I misheard the second question on the short-term capital gain. Is the gentleman asking
STCG
how?
On shares enjoyed.
So short-term is taxed at regular rates, and there is no indexation. I think I didn't get the question. Sorry. Can you just repeat the question once more for the STCG?
Okay. It's basically saying that he's asking that he's enjoyed gains of more than 1 lakh rupees on and they are short-term capital gains. So he wants to know how will it be taxed, Amit?
So it would be just added to the to the regular income and would be taxed as per slab rates. That's very clear.
All right, it's fair and simple. So whatever your tax slab is, this short-term capital gain will be added. But I think with that, we're completely out of time. Amit, thank you so much for joining us once again on the Money Show with your, with your insight on managing capital gains and, answering our questions and queries as well from our viewers.
Thanks.
We'll have to just take a very short break on the show, but when we return, we will be joined by Gurmeet Chadda, co-founder and CEO of Complete Circle Consultants on how should one read an annual report. Be right back.